David Kelly says the Fed is one step closer to deciding to taper. He's chief global strategist at JP Morgan Funds. Hi, David. So how close is close? Besides that jobs report that Hampton was just reporting on, we got that strong GDP number yesterday, this week, strong auto sales, strong home sales, good news on manufacturing, good news on, Cyber Monday. How do you think the Fed looks at all this data, and could they taper this month?
Yeah, I think they could. I'd call it about a 50-50 shot as to whether they taper this month. Logically, they absolutely should. I mean, if the Fed's going to be consistent, you go back to last June when Ben Bernanke first talked about ending QE. He said that they would start later this year and they would end when the unemployment rate hit 7% roughly. Well, we're actually at 7% already. And in fact, if you go down the list of the things the Federal Reserve has been worried about, including unemployment being too high, problems with the federal government, problems with housing, the numbers really seem to calm those fears. So logically, the Federal Reserve ought to begin to reduce bond purchases at its meeting next week. The only question is, we thought that in September, and they were, too nervous to do it then. So will they still be too nervous to do it in December?
So what do you think's holding them back, David?
I just think that they are the personnel in the Federal Reserve right now is about as dovish as we have ever seen in 100 years of the Federal Reserve. I'm not sure what should hold them back any further, but I've called them wrong in the past. So I don't want to say that it's a sure thing, but logically they absolutely should begin. This is the most extreme monetary policy we've had in 100 years of the Federal Reserve, and it doesn't make sense with the unemployment rate coming down and all the numbers that Susie talked about. The economy is a little too strong for the Federal Reserve to keep emergency measures in place.
David, so when the Fed does taper, bring this home to our audience. What does it mean for people's investments, their portfolios, and what does it also mean if you're a borrower for mortgage rates or in other personal loans?
Okay. Well, first of all, for the economy, it does, I think, mean that 2014 will be not a great year for the bond market, just like 2013 wasn't. We expect that long-term interest rates will go up somewhere between 50 basis points and 1%. So not that much, but they'll go up, and that hurts bond returns. For the stock market, I think the stock, I'd always pick an improving economy over monetary medicine. I think this is actually better for the stock market. So I think the stock market can continue to go up. Of course, it's gone up a lot. And then for individuals, I wouldn't worry too much. I know interest rates are going to go up, but they are at very low levels. Mortgages are still an excellent deal. So if you can afford to buy a house and you can actually get a loan, I still think this is a good time to buy.
The typical paradigm, David, has always been that as rates go higher, as interest rates rise, that's poison for stocks. Why do you think the two can coexist with both rates and stock prices rising?
Well, Tyler, actually, it depends on where the rates are when you start. We've looked at data over the last 50 years, and what we found is that so long as 10-year Treasury rates are below 5%, when they go up, that's really a sign the economy is improving, and that actually helps the stock market go up. If, on the other hand, rates were, say, 8%, they go to 9%, it means you've got a raging inflation problem, and that really is a negative for the stock market. So if you start at a low level, rising rates aren't really that much of a threat to the stock market.
All right, David, thank you so much. Always a pleasure to have you on the program. Have a great weekend.
You too.
David Kelly, Chief Global Strategist at JP Morgan Funds.